Hi, everybody. Welcome to another episode of the 7 and 7 Show with Zack Ellison. Today, I have with me Jackson Streeter, who's the director of UF Innovate Ventures. And Jackson, thanks for joining.
Hey, Zach. Thanks for having me.
Yeah, it's a pleasure to have you. So we both have UF ties. I'm finishing up the doctorate in business administration program there, and really impressed with what UF is doing generally in innovation. So talk to me a little bit about what you're doing now and what UF Innovate is and what UF Innovate Ventures is.
Yeah, sure. So I run a venture capital fund for the University of Florida, and I got brought into UF at the end of 2019 to put the fund together. And the way this is a not a grant program. This is an equity investing program like any other venture fund. It is a little different in that it is part of the University of Florida. And so I came in the end of 2019 and put together an investment advisory committee. So the way we set this fund up is that we have an outside group of independent people from the university that are primarily venture capitalists or kind of scattered around the country that kind of look at deals before we finalize writing a check. So put that together at the end of 2019 and then began investing the early part of 2020, sort of right when we launched the fund was right when COVID took off. But that, honestly, it really didn't slow us down all that much as it may have in other states. I think, in Florida, we kind of just got back to the office early, started doing stuff and started investing. This fund, we only can invest in companies that have a licensed technology from UF. So that's a criteria for us to invest. They can be located anywhere in the world. I'm currently sitting in Bilbao, Spain, which is where one of our portfolio companies, Satlantis, which is a satellite company, is headquartered. And they do their AI and sort of advanced computing research still at UF, which is where the company was formed. So our check size is relatively modest. It's up to $500,000. And we don't lead deals. We co-invest with syndicated institutional investors, other venture capitalists, and can be in any industry. So we've got investments, like I've mentioned, in a satellite company. We've done about half of our portfolio, 12 companies now, is in healthcare. And our upcoming newest investment will be in a material science company that's in San Diego. So the really cool thing about my job is that I get to see a lot of really cutting edge research in a lot of different industries and fields. So it's a pretty interesting job.
So how did you get to this position? I know one of the things that is pretty cool is you've got a medical doctorate. So what did you study in med school, and how did you go from med school to where you are now?
So that I have a very circuitous route to where I'm at today. I started out as a U.S. Navy doctor. So I went to medical school on a Navy scholarship, and then spent 8 years as a Navy flight surgeon. And then my last job there was probably the best job I'll ever have, which I was the first flight surgeon that got accepted to be on the Top Gun staff. So wow. I ended up with about 400 hours in the F-18. It was really fantastic, and got to be with some of the greatest, pilots in the world, which is really awesome. Then in the mid 90s, I was looking at a couple different career options, and one of them was to start a company. So I founded a med tech company in San Diego and decided to do that full time, and went ahead and got out of the military at that point. So I did a couple medical technology companies in San Diego, which is where I was when I got out of the Navy. They were venture capital backed companies. So I kind of learned the process of venture capital and starting a company with like no formal training, just went out there and did it. So I remember going to Barnes and Noble and buying a book on like how to write a business plan. and so I basically learned everything the hard way about this. So last company out there ended up getting rolled up by a private equity firm. And along the way, I had discovered some interesting science and literature that some researchers at the McKnight Brain Institute at UF had discovered some proteins that could be detected in the blood after brain injury. And my field of research and what I had worked on a lot was in stroke. And I was interested to learn if these blood-based biomarkers that they had developed for concussion and traumatic brain injury could be relevant to stroke. So I came out to UF to look at this technology because I thought it was really interesting. One thing led to another, and they wanted me to come on board and be CEO of a startup company at UF. So I went back to San Diego and convinced my wife it was a good idea to leave San Diego and move to Gainesville. So that's how I ended up out there.
How does she like
That's
it?
how I got to know the University of Florida. That company was called Banyan Biomarkers, and we had great partnership with Department of Defense. We did develop a blood test for concussion and got that approved by the FDA. Ultimately, did a commercialization deal with Abbott, and then that company was acquired by a large French diagnostic company called bioMérieux. And you know, my family and I, we enjoyed raising our kids in Gainesville. That whole process with Banyan, you know, several years, we didn't really want to leave. And so Jim O'Connell, who runs UF Innovate, asked me to come on board at the end of 2019 and get this fund going. So that's how I ended up doing what I'm doing.
Wow, that's very cool. You know, it's funny. I just watched a movie recently about the Blue Angels. That they're amazing pilots. Did you ever interact with them?
You know, I had a few guys that I flew with at Top Gun ended up going into the Blue Angels, and a couple of them became the boss, which is the commanding officer of the Blues. And so, yeah, what they do is it's a pretty awesome, you know, things that they do routinely that we didn't, you know, fly 18 inches from each. You know, they would never let the doctor fly that close to another jet ever. But yeah, they do some pretty awesome stuff, and we did some awesome stuff at Top Gun that was different. You know, it wasn't demonstration flying; it was really tactical, and so I really enjoyed it. It was really cool.
That's very cool. I feel like that would be probably the most exciting job to have, is being a fighter pilot.
Yeah, you think it's dangerous, but then you get out and start raising money and starting, you know, biotech companies. You realize what real thrills and danger are all about, right? Dealing with investors and all that stuff.
So before we move on, I wanted to ask you just a little bit about Gainesville. I think Gainesville is actually very underrated and one of the best places that people can live nowadays. But I just wanted to get your thoughts on it for those that think of Gainesville as just the swamp, but don't realize what a great community it is.
Yeah, no, I mean, Gainesville punches above its weight, you know, in a major way. I mean, you go back to, you know, Gatorade obviously is the thing that, you know, everybody really knows about. But, you know, we have 100,000 square feet of incubator space. We've got 60 plus companies that, you know, are inside the UF incubator system. There's a vibrant startup sort of mentality around the town. There's a few different, you know, sort of co-working accelerator type things. So culturally, Gainesville is really friendly to innovation and starting things, and it's pretty good. And one thing that in our incubator system, we've been recognized internationally as having, you know, several times the #1 biotech incubator up in Alachua in the world. And so not all the companies that are inside the incubator system have to come from UF. We've had companies come from several different countries, Brazil, you know, several European countries, companies come to the United States and they land in Gainesville to get their companies started. So it's a pretty good place.
Yeah, I mean, one of the things I love about Gainesville is that it's, first of all, you got the University of Florida there, which is just a tremendous asset, tons and tons of talent that you alluded to on all levels, right? Because there's students, there's professors, there's a lot of innovative companies that are choosing to make Gainesville home. And also that, you know, the cost of living is very, very reasonable. Obviously, the state of Florida has a lot going for it in general. And Gainesville is also pretty close to other major cities. You know, it's 2 hours from Tampa, hour and a half from Jacksonville, hour and a half from Orlando. And you know, the University of Florida also is a good time in terms of all the activities that surround it. I mean, where else can you go to a football game with 90,000 people, for the cost of yeah, less than you'd spend going to a movie, right?
Yeah, and in the same weekend, see something very cultural like a world class, opera singer or ballet or whatever. It's not just athletics, which I love, but there's a lot of cultural things that come with UF there in Gainesville too. And when we came from San Diego and we saw the price of housing, we were like, wow, can we get two?
Yeah.
So,
Well, you can probably get four for the price of one on a square. Actually, probably
almost,
more, almost more.
yeah,
If you look at it
almost,
on a square price per square foot basis, it's so much
yeah,
cheaper. And one of the things I like, just for those listening, and for you, Jackson, I've actually moved to Florida full time. So I'm in the St. Petersburg area. And that's mainly for lifestyle reasons, but also business reasons as well. And I really like Gainesville quite a bit, and I want to open an office there for A.R.I. because I just think there's so much talent and there's so many good students too that are coming out of UF, and so many good companies to connect with. And we were talking about this offline, but I think Florida as a state is going to be kind of the next big thing when it comes to innovation. I just think we've reached peak Silicon Valley, and Boston and New York and other larger cities that were historically venture hubs have peaked in my view. And not that they won't still be the largest, but in terms of growth rates, it's going to be Florida and it's going to be the Southeast US in my view, because there's just so much talent flowing down here. The lifestyle's better, the business environment is much more friendly, and there's just a ton of talent coming out of places like UF. So I'm just very bullish on this area, which is one of the main reasons I moved down here. And that's also why I wanted to go to University of Florida to get my doctorate, because I feel like this is the next the next big thing. And I always want to be associated with the cutting edge of growth and innovation. It's happening here. It's not actually happening in some of the larger cities, in my view.
yeah. No, you made a good choice, Zach. I mean, you look at there's $2.5 billion of publicly funded research going on inside the state. About half that occurs at UF. So if you look at like what drives innovation, Silicon Valley, obviously you got Stanford and UC schools there that, it's sort of the fuel underneath to sort of fuel innovation comes often from research universities. And we have that in Florida. Um, University of Florida has also expanded out of Gainesville. We've acquired the Scripps Research Institute in Jupiter, is now part of UF, which is some of the world's leading biomedical scientists are there at Scripps, and we've already started 3 companies from there. So there's a lot going on in Florida, and typically Florida has been sort of underserved and still is actually from a capital perspective, but that's changing, and you're seeing now, and I think really since maybe since COVID really drove a lot of the private equity, some of the investors, a lot of, Ken Griffin down in Miami, obviously. But a lot of wealth has moved down, and they probably always had homes down here, but now they're moving their companies down here. And so this is a good place to be. And it's a good place to do company formation. I mean, it's tax friendly. Like you mentioned, real estate, is relative to New York and California and Massachusetts. This is a place it's moving in the right direction for sure. I get to interact, every so often with some of the undergrads, and I think, a lot of them don't want to leave, but if the jobs aren't there, then they end up, getting educated in Florida and then doing their careers outside of it. And that's one of the things that I think is moving in the right direction too. There's a lot more companies being formed in Florida, staying in Florida. And one of the keys for that, at least in the world that I'm in, is whether those companies can get early stage capital or not. And if they get that sort of seed and Series A funding, and they build a team in a certain location, it's really kind of hard to move a company at that point. But if they get their their seed and Series A funding in Boston or Silicon Valley, they'll never come back. So there's still a need for more of that early stage funding in Florida, but it has increased over the last few years, and the state is putting money to work through the Florida Opportunity Fund, and so that's a early stage venture capital program that the state is committed to funding Florida-based companies through.
So if there's a startup in Florida that is seeking funding, what's the best way for them to get on your radar and potentially get UF Innovate Ventures to invest?
So for me to invest out of UF Innovate Ventures, they'd have to have a licensed technology from UF. But that said, I spend probably at least half my day interacting with entrepreneurs that will never happen, or it's not relevant to what they do. So I'm very open to just, pointing people in the right direction, as long as they have a Florida-based entity. I also look at the life science investing opportunities for Florida Opportunity Fund that is managed by DeepWork Capital in Orlando. So I could point them there. There's several active angel groups. It depends on what the startup, does. Some angel groups don't look at, many of them don't look at biopharmaceutical opportunities, for instance. They're really more tech focused. But yeah, I'm more than happy to point them to the funding sources that we have connections with, for sure.
So generally speaking, for founders that are early stage, let's say seed stage or Series A, what advice do you give them in terms of just big picture and potentially capital raising and just building their business in general?
So I think one of the really, really important things, if you look at the reason, most startups fail, right? And it's been analyzed, and we've done this sort of analysis ourselves, and it reflects what happens nationally, is there isn't really a market for the product. So you'll see, and I think anybody that's any VC will tell you, you'll see very excited entrepreneurs about a product, but it's really not clear who's actually going to buy it and how big the market is. So I would say really have a really deep understanding of who is the customer ultimately going to be, and do they care, right? I mean, we've seen some things that get built and it's not a technology that fails. It's just that there was really no market for it. So having a really deep understanding of who's going to buy it, how much are they going to pay, and what's the competitive landscape going to look like. So that's sort of really fundamental. And if you go through that sort of exercise and you really are convinced that, yeah, there is a market for this, then, I think really you need to get investors that can be helpful to you. So, investors that have experience in the industry that you're going into can be really important and valuable. And putting together advisors, if you're a first-time CEO, that have experience in the area that you're working in, that can really be, prevent you from making costly kind of dumb mistakes, maybe.
So there's a couple things I want to dig into there. In addition to the product, which is really important, what else do you look for in terms of the team, the business model, or other key factors?
Well, so I think the longer I've been, on the investment side of the equation, the more I'd say, for me anyway, maybe 50% of an investment decision is who the people are. And at an early stage, no one is going to have the full team built out, necessarily, of course, they're not going to have all the money, but at least being able to show that they're coachable and can receive input and act on it. And that becomes really important, because if they're not, because any startup is going to have a lot of ups. It's a roller coaster, right?
Mm-hmm.
And it can go from the highest highs and the lowest lows, all in the an 8-hour day, right? So you really got to look at people that are sort of adaptable, receptive, humble, but confident. I mean, it's sort of a lot of little sort of things that are a little hard to quantify, but I think the more that you do this, you realize that a lot of those qualities are super important.
Yeah, just to go back to your first point on product, I always think, what problem are they solving? And are customers willing to pay for this problem being solved. And then it's looking a little bit further at their competitors and saying, okay, are there other people that are already solving this problem or that are trying to solve it, and how, you know, how do they fit into the mix? But that, I kind of start with the, to your point, the product, and making sure that they're supplying customers with a product that they actually need and want and will pay for. And then on the leadership side, everything you said makes total sense. And I would add to your point about coachability, I really think working with people that are aligned with you and that are just easy to work with, right? Because if everything's difficult, you can find other people to work with. And so I always give people the advice that, hey, just be somebody that others want to work with, and a lot of good opportunities that you may have not even known were there will appear before you. If you get that reputation, you keep living that way.
I think that's great advice, Zach. I mean, there's plenty of deal flow at the end of the day. I mean, you will see, 100 deals to do one or two, so, and then, getting with the professional, with venture capital investor and an entrepreneur, it's a bit like a marriage. I mean, you're going to probably spend a lot of time with these people. So it has to fit both ways too, right? As from the entrepreneur side, if the chemistry is really bad, that often doesn't work. So it's got to be a good fit for all parties, I think, for it to really flow, because there's going to be tough times for sure.
And that brings me to my next point, which is choosing investors is critical to long-term success. And I think a lot of people early on will take any money that's offered to them. And sometimes you have to, because it's just hard to raise money, especially when you don't have a track record. But I think a lot of folks realize later on that maybe they shouldn't have taken money from certain types of investors because there wasn't that fairness, that alignment, and that transparency that they need to be successful. So I wanted to get your thoughts on what founders should be looking for when they consider who they're partnering with on the investment side, and maybe any red flags that you've seen over the years in terms of what might make the fit difficult.
Yeah, this is really important. And you'll see often, you've probably seen this too, where you get some friends or family or some maybe angels involved in a deal, and they have completely unrealistic expectations because they really don't know what they're investing in. And I've seen this happen in life science startups several times, where people are concerned about Alzheimer's disease. They know nothing about drug development or diagnostic, whatever the technology is. They know about the disease because maybe they have some personal, connection to it. So they invest in things that they don't understand. So from the entrepreneur side, you really, if you can, I understand there's a reality that you need money at the end of the day. But if you can get people that understand what you do and what you're trying to accomplish in the industry that you're in, that can be really important. And another thing that will happen is at formation, the company, if the company isn't formed right, that can lead to a whole slew of problems. If it's not formed right, you raise early stage angel or friends and family money at some unrealistic high valuation, then it has to be recapped. Because now when you go to professional investors and they're looking at, let's say they're looking at 3 deals, and one of them just has to be completely restructured. All of them are maybe sort of equivalent value or potential, returns, but one of them you have to spend all this time to fix it because it wasn't, formed correctly in the beginning. They're just going to pass, right? Because it's just hard. So they'll just go do the deals that don't have to be fixed. So I would say at formation, if possible, get the lawyers, the law firms that know how to form early stage tech-based companies. They'll form them right and they won't have to be fixed. And then with your investors, again, like we mentioned, trying to find people that have experience in what you're doing can be really important. And don't raise money at the highest valuation necessarily that you can from angels, because, what you really want to do is whatever your financing, strategy is, seed, typically like pre-seed, seed, series A, should be step-ups all along the way. You really don't want to have to reset valuation on the early stage angels. You got to go back, have difficult conversations, so it's just better not to do it like that. So getting lawyers involved, we all kind of complain about lawyers like we were doing before we started. But they do have a role, and it can be really important, especially in the early stage.
Yeah, I think this point that you made about valuation is really important and getting the cap table right early. I always go back to this principle of beginning with the end in mind and thinking, okay, what does this venture need to look like in 5, 10, 15 years? And how do I put in the foundation now so that I'm able to achieve those 5, 10, 15-year goals? And I think a lot of people rush through the foundational stage, and so they build a house on a shaky foundation, and it ultimately collapses. And one of the things that people get wrong that you alluded to and that I want to dig into is raising money at a valuation that's too high. And it sounds counterintuitive, and this is why I want to get your thoughts on it, because a lot of folks would say, well, of course I want to raise money at the highest valuation. But if the valuation is unrealistically high and can't really be justified, it can lead to many negative repercussions. So I'm curious if you could just dig into that for people that don't really understand what can go wrong in that scenario.
Yeah, maybe what it'd be helpful to talk a little bit about what's called venture math and how venture capitalists will look at an investment that typically they got to look at an investment where they're going to say, well, we're going to need to see 5 to 10 times return on our money, because even the smartest funds in the world are going to have 6 out of 10 investments don't go anywhere. So the other 4 have got to carry the fund and return all the capital plus more. So they're going to be looking at like, how am I going to get a big return on my investment? How long will it take? And how much money is the company going to have to raise to get to that exit for my fund? So that kind of becomes important. Like, what are the comps in your field that have been acquired or have gone public, and what have those exits look like for those investors? So then you can kind of then start to understand how the professional investor will start looking at valuation at the early stage, because they'll factor in, well, this company's going to need 5 million now, it's going to need another 20 before it gets to exit, so I've got to hold back so I can continue to participate. And what will their position look like on the cap table? Just this is, we're not going to get into all the real details on this in this podcast, right? But this is where an experienced lawyer really can be valuable, to walk the entrepreneur through, what's this cap table mean? What is the position of ownership going to look like on a go forward basis? And one thing that, like any investor will just kind of roll their eyes if they hear, well, this is a $10 billion market, and if I just get 1% of it, it's gonna. So that's just not the right way to think about it, right? So because a lot of people will say that, and nobody takes it seriously. So
one thing that I think a lot of people need to hear is that once you take money, you're on the clock. And if you take money at a high valuation, the clock is ticking faster. And I think that's what a lot of people underestimated over the last couple of years when they took money at really, really high valuations in 2020, 21, and first half of 22. And then they realized, oh, wow, I'm not going to be able to raise money in the future at my previous valuation. And so then they're forced to either do what's called a down round, meaning they're raising money at a lower valuation, and that makes nobody happy generally, right? Because of course you've got the existing investors that realize that their investment value has plummeted in some cases, and new investors are seeing this as a negative signal, right? And so I've been talking to a lot of founders recently who are full of regret, actually, from taking a lot of money at really, really high valuations. And then they realized, wow, we'll never be able to reach that valuation, which means they start flirting with what I call the startup death spiral, where their employees now have options that are probably not going to be worth anything. So they start to look elsewhere and maybe leave, right? Which means that operationally, the company's growth is going to slow because their most talented employees are going to go elsewhere. And then when growth starts to slow, that scares away future investors. It also causes current investors a lot of angst. and it basically spirals on itself. You just lose more and more talent, your revenue starts to slow, your valuation drops further, and before you know it, you're out of business. And I think a lot of companies right now are actually caught up in that death spiral. They just either don't know it. Most of the time they should know it at this stage, but they don't want to admit it, of course. But I think we're going to see a lot of companies, failing and closing their doors over the next couple of years, because if you think about startup funding cycles, it's really every 2 to 3 years you're raising another round of capital. And the last 2 years, roughly, the market's been shut for the majority of companies. And so now they're running low. Their burn rate wasn't sustainable. They never really figured out how to reach profitability. And so they didn't have sustainable business models absent external funding, right? And so a lot of founders are coming to me now looking for venture debt because they don't have as many options as they would like on the equity side. But of course, venture lenders aren't looking to finance companies that are dying. We're looking to bet on the winners, right? That have done really well. And so really a lot of these companies are just out of options. And a lot of folks are now saying, man, I should just bootstrap my company longer. I should have just sold less equity at a lower valuation, because a lot of founders were actually being pressured by VCs to grow at all costs, and their burn rates were not sustainable, but the VCs would keep pushing them, saying, don't worry, you can raise more money. Just keep raising money and keep spending and you'll be fine. And then that faucet of liquidity got turned off. And now the VCs are nowhere to be found with a lot of these companies and have abandoned them. And the companies are saying, man, I really shouldn't have taken the advice from my investors. I should have thought about other options in advance.
Well, I tell you, in biotech, there's been a massive, reset on valuations, and it kind of it's interesting what you look at how all that's evolved over the last few years, where the public markets opened up, there was a ton of money went into a lot of things that probably shouldn't have gotten funded. A lot of companies end up going public that are now, withering on the vine or going out of business. So there is sort of a herd. You're kind of talking a little bit about when things get frothy and money is everywhere, but you're raising a really important point, is that never lasts forever. The business cycle will always cycle again. So again, I think this goes back to having people around the table that have lived through some cycles and can give you the right advice, and rather than just just go out and raise this money that you're going to just go spend it just to spend it. I mean, that does happen in these really frothy times, and you do need to be careful of that. So, and then there's when the cycle comes back the other way, there's pain, right? There's pain because you didn't raise the money you needed to get to break even, or to get, I work in life sciences a lot, to get to some really meaningful clinical trial endpoint, let's say. You still need more, and now the money isn't around to get it. So and that's where companies just go out of business often. Yeah,
I know it's sad, because we of course want to see people be successful. And so my goal, one of my many goals, is to help founders understand all the potential pitfalls while they're still very early, and try to avoid those, because a lot of them are foreseeable if you have experience and if you've done the research, and they're going to be a risk. And so there's definitely ways to plan around that. And one of them on the capital raising side and cap structure side is really, I think, to be a little bit more conservative and maybe bootstrap a little bit longer, figure out if there's ways to take the minimum amount of external capital in each round instead of the maximum, and do it at valuations that are fair, but not too frothy. Because what you can do then is really continue to show momentum. It's kind of like the public stock market, for instance. When you beat expectations consistently, investors like it. You can be doing really well, but if you miss expectations, your stock is going to get punished. And it's the same for smaller companies as well. It's all about managing expectations, I think. And Another thing I'd mention too is just not giving up too much equity early, because a lot of folks are like, oh, it's okay. I just got to get off the ground. So I'm going to give my co-founder, 25% or 50%. I'm going to give my anchor investor, a big chunk. And then they realize later there's just not enough meat on the bone to continue to raise external capital. But to your point, they haven't really gotten to profitability yet and sustainability. And so then they're really at risk because they don't really have anything more they can sell. But they're not there yet. And that's where I think a lot of companies are right now in their life cycle, is they're kind of like stuck between between a rock and a hard place.
Yeah, I've seen this with founders, and this is where there's no vesting over time because things change. People don't get along, they get sick, whatever, and they got all this equity, and then they're not even involved with the company anymore if it's just given away in the beginning, right? So again, this kind of goes back to having experienced, a company formation from a legal perspective and how you set up giving out equity. That just, often it's just better if it vests over time, so that's just not all given away and then it's irretrievable. And so that can lead to a lot of issues for sure.
Are there any other pieces of advice you'd give to founders that you think
Well,
they?
yeah, I mean, so I this doesn't necessarily apply to the pure SaaS or tech companies necessarily, but if you're in a field of engineering or certainly in all the life science companies, your intellectual property is really key. That's sort of, you use the analogy of the foundation of a house, and in those companies, that foundation is the IP. So, and ultimately, most things get acquired. That's how exits typically occur, and the strategic companies that are coming around to pick up those assets, they're really buying the IP almost always at the end of the day. So really making sure that you've done everything you can afford to do to protect that. And so I think that's important. And then just to the investor side again, first early stage entrepreneur, you're not going to have everything in place, but I always look at money as raising money as sort of like dominoes, where you need the money to tick over the next domino. The pathway of all the things you're going to need to do, who you're going to need to hire, what kind of, things you're going to have to in-license or whatever, all the events you're going to do with that money. And whatever money you raise, you really want to make sure you're raising to get to some kind of significant milestone, whether that's MVP, minimal viable product, or, getting to some clinical study that is going to drive value. So raise the amount of money you need to get to a milestone. Don't leave yourself stranded by not raising enough money to get to something meaningful.